Okay, think of a giant corporation like a family, and its big official financial statement. Well, that's the annual family portrait. But who actually gets to be in that picture? What if some of the family members are, hidden from view? Today, we're diving into the rules that decide who makes the cut.
You know when you see a big, familiar company name? Turns out, you're often just seeing the tip of the iceberg. Underneath the surface, there's usually this whole complex web of other companies that it owns or influences. So the real question is, how do we get a look at what's really going on?
Well, the answer is something called a consolidated financial statement. It's basically the accounting world's way of getting every single member of that corporate family, no matter how big or small, to stand together for one complete official portrait. No one gets to hide.
All right, so let's start with the basics of this so-called family portrait, what it is and who the main players are.
So, what these statements do is they take a parent company and all the companies it controls, its subsidiaries, and they basically blend all their finances together. The whole point is to show investors and the public what this group looks like as a single, unified economic machine. No hiding behind separate spreadsheets.
And in this family, you've really got two main roles. You have the parent and you have the subsidiary. On the surface, it seems simple, right? The parent is the one in charge, the subsidiary is the one being directed. But that whole relationship, everything, hinges on one single powerful concept: control. Now, there's an official rule book for this, IND AS 110, and it's crystal clear. A parent company must prepare these consolidated reports. But here's what's so important to get. This isn't just about owning more than 50% of another company's stock. The real ultimate test, the heart of this entire standard, it's all about that one word: control. So, how do people actually figure out if one company controls another? I mean, it can get complicated, right? Well, it's not just a gut feeling. There's a very specific three-part test they have to apply every single time. And here's the catch. These three elements have to work together. You can't just have one or two. First, you've got to have power. That's the real ability to call the shots on the important stuff. Second, you need exposure to returns. That means you get the upside when things go well, but you also feel the pain when they don't. And third, there has to be a link. You need to be able to use your power to actually change those returns. So, and this is absolutely crucial, an investor only has control if they can check all three of those boxes. It's an all-or-nothing deal. Now, out of those three, the one that gets the most complex, the one people debate about the most, is power. So let's zoom in on that one, because it's definitely not as simple as just counting votes. Right, this is where we have to look beyond the obvious. Having power isn't always about owning the majority of the shares. The rules are smart enough to know that influence can be way more subtle than that. To really get what power is, you first have to understand that there are two different kinds of rights. Think of it like offense and defense. Substantive rights are your offense. They give you the power to actually direct what the company does, like setting the strategy. Protective rights, on the other hand, are pure defense. They let you block certain huge decisions to protect your investment, but they don't let you steer the ship. Let me give you a perfect example. A bank might have the right to seize your factory if you default on a loan. That's a huge right for sure, but it's protective. It doesn't mean the bank is running your day-to-day business. Same thing for a minority investor who gets to veto something truly insane, like selling off the entire company. They're just protecting their cash, not running the show. Okay, so this all leads to a really fascinating question, one that accountants and lawyers argue about all the time. Can you actually control a company, even if you own less than half of it? And the answer is a resounding yes. This is what's known as de facto control. Just look at this classic scenario. Investor A has 45%. Now, that's not a majority, but if the other 55% is spread out among thousands of tiny shareholders who are never, ever going to get together and vote as a block, who has the real power here? Investor A does. They have the practical ability to win every vote. In the eyes of the rulebook, they have power. So the rule sounds pretty absolute, right? A parent must consolidate. But are there any get-out-of-jail-free cards? Any exceptions? Yes, but they are incredibly narrow and very specific. And let's be super clear about this. These aren't some sneaky loopholes you can exploit. They're very carefully crafted situations where making a whole separate family portrait would just be redundant or wouldn't make sense. But getting out of this requirement is really, really tough.
A company can only get a pass on consolidation if it meets all four of these conditions. What this is really designed for is what you might call an in-between parent company, one that has subsidiaries but is also a subsidiary of an even bigger parent. If that top-level grandparent company is already making a public family portrait that includes everyone, and the company in the middle isn't publicly traded, then it might be exempt.
And I have to say this again because it's that important. It's not pick and choose. It is all four. If your company's stock is traded on an exchange, boom, you fail condition 2, you have to consolidate. If your ultimate parent is in another country and doesn't use the same accounting rules, boom, you fail condition 4. It's designed to be a very, very high bar to clear.
All right, so we've been deep in the weeds with all these technical rules about control and rights and exemptions. Let's zoom out and ask the big question. Why do we go through all this trouble in the first place? Honestly, it matters because without these rules, the financial world would be a much, much murkier place. It all comes down to transparency, to giving everybody a fair and accurate look at what's really going on inside these huge, complex corporate groups. This right here is the real superpower of consolidation. It stops a company from playing a financial shell game. Shuffling all its debts and risky assets into some forgotten subsidiary to make the parent company look amazing. Consolidation says, nope, sorry. It forces the entire group to stand together and show the world its combined financial health, giving us a true picture of its size, its success, and, most importantly, all of its risks. And that quote on the screen, it really just hits the nail on the head. The whole reason we have these rules, the reason we define control so carefully, is to pull back the curtain and show a single, truthful economic reality. It's one of the bedrock principles of modern finance. It really makes you think, doesn't it? The rules for consolidation shine a bright light on one really complex part of the business world. But it makes you wonder, what other important secrets are sitting right there in those financial reports, just hidden in plain sight, waiting for us to learn the language to understand them?